Okay.
Good afternoon, everyone. We will be exploring a topic that sits at the intersection of regulation, law, and the evolving world of banking, from regulation to relationship, legal and practical dimensions of banking governance in the digital age. In this presentation, we will look at how financial regulatory frameworks shape and are shaped by the legal relationship between banks and their customers. We will begin by examining the purpose and structure of financial regulation, focusing on the Australian model and considering how it compares to other jurisdictions. Then, we will turn to the banker customer relationship itself, what it legally entails, how it is formed, and how foundational concepts like deposits and accounts are treated under the law. We will also consider whether traditional legal principles are still fit for the purpose in an era defined by digital banking, data driven finance, and shifting consumer expectations. Together, these two dimensions, regulation and relationship, will reveal how legal structures must continually evolve to maintain both trust and efficiency in a rapidly changing financial landscape. We are the banker, and my name is Isabel C., and my groupmates will also introduce themselves.
Hello, my name is Nidipatma Samlan. You can call me Tan. I'm so happy to be here today to discuss about the Australian financial regulatory approach.
Hello everyone, my name is Hongzhi Zhang, but feel free to call me Henry. I'm very glad to be part of this group and to have the opportunity to discuss topic around regulation and the bank-consumer relationship as part of our banking law units.
Hi everyone, my name is Wanapan Damrong, or you can call me Winter. For today, I will produce you about the legal status of the deposits and the bank account related with the law.
We'll begin our discussion by giving an overview. I will talk about financial regulation, while Tan will talk about financial regulatory approach in Australia, while all of the members of our group will talk about financial regulation in other jurisdictions. So, regulation. The financial crisis of 2007 to 2009 was the most severe economic shock the world had seen since World War II. It triggered a sharp downturn in the economies of developed nations, wiping out over 15 trillion in value, around one-fifth of the world's annual economic output. Businesses slashed investment, they laid off workers, and unemployment surged. The ripple effects were devastating, and many countries are still recovering. In an effort to contain the crisis, national governments intervened, but their action gave rise to a new threat, a sovereign debt crisis in the Eurozone, one that continues to fuel economic instability even until today. Naturally, people began asking, what went wrong? And more importantly, how do we stop it from happening again? One major factors, experts believe, was the failure of financial regulation. As financial markets and institutions pushed the boundaries, regulation couldn't keep up. The result? A system vulnerable to collapse. Regulators were outmaneuvered, lax oversight allowed risky behavior and misconduct to flourish until the inevitable crash. To avoid repeating those mistakes, there's a clear need to rethink how financial regulation works. A better understanding of its role and structure is essential so that financial system can be stronger, more stable, and better prepared for the future. If we want to make sense of financial regulation, what it is and what it is meant to do, we have to start by looking at what it's trying to regulate, the financial system. We all interact with it, whether we are saving money, using a debit card, taking out a loan, or investing in the stock market. But those are just glimpses. What we don't see is the full machinery behind the scenes, a massive engine of individuals and institutions that keep it functioning. So, why do we regulate? The standard starting point of economics for regulation is that if it's not broke, don't fix it. In other words, if there is no clear evidence of a failure of markets, do not interfere with them. In a well-functioning market, competition acts like an invisible hand. guiding people and businesses to make decisions that lead to efficient use of resources. Prices, wages, and investments are set not only by a central authority, but through countless independent choices made in decentralized markets. This system usually works remarkably well. It promotes efficiency, encourages innovation, and balances short-term needs with long-term growth. But while competitive markets are powerful tools, they are not perfect. Sometimes they fail to deliver fair or efficient outcomes, and that's when careful regulation may be needed. However, financial markets are vulnerable to failure, and here's why. In most markets, the impact of a decision shows up quickly. Buy or sell something, and you can see the results right away. That makes it easier to keep things running smoothly. But finance works differently. In this world, the real consequences of a decision, like a risky loan or an investment, might not show up for years and sometimes even decades. The time lags make it so much harder to detect problems early and even harder to fix them once they appear. Thus, regulation exists at its core to address market failure, situations where markets don't produce efficient or fair outcomes on their own. But just because a market can fail does not automatically mean that the government should step in. Deciding when and how to intervene is one of the toughest challenges governments face. Too much regulation can slow the economy down. Too much little can leave people and businesses exposed. That's why regulatory efficiency matters because bad regulation comes with a price. Higher taxes, poor services, inflated prices, and stalled growth. The most effective way to keep regulation useful and its costs under control is to design it with a clear and consistent framework, one that helps governments strike the right balance between oversight and economic freedom. So, how do we design a regulatory system? There are at least three stages involved in designing a regulatory system. The first is to determine the nature and extent of any market failures that exist. The second is to establish the set of possible of regulatory interventions and to identify the appropriate combination required to remedy each failure. The third is to evaluate the costs or side effects of such remedial intervention and to determine whether they are so great as to outweigh the benefits. If the cost of a particular intervention exceeds the benefits, then either an alternative remedy needs to be sought or the failure in question may be permitted to remain uncorrected. What is efficiency of market? The purpose of regulation is to assist market in functioning better than they would do in its absence. Thus, the most important criteria by which economists judge how well an economy is functioning relates to the market efficiency with which the economy produces and allocates resources. The starting point is that most resources, such as commodity, raw materials, labor, and capital, are scarce. They are therefore expensive to employ and need to be utilized as efficiently as possible. Efficiency in this sense has three meanings: productive efficiency, allocative efficiency, and dynamic efficiency. And what affects markets in regulations are market failures. And there could be, these are the possible reasons: asymmetric information, negative externalities, public goods, imperfect competition, and biases. So, what are really the key goals of financial regulation? Having described the merits and defects of the markets, the next stage is to determine what policymakers can legitimately be seeking to achieve through regulation, namely, the goals of regulation. The first one is maintaining financial stability. This means ensuring the safety and soundness of financial intermediaries like banks and insurers and the overall resilience of the financial system. The second one is protecting users of the financial system. Regulation ensures consumers and investors are treated fairly and have access to safe financial products and services. Thirdly, preventing financial crime. This includes stopping fraud, money laundering, and insider trading, which undermine public trust in financial systems. Fourthly, facilitating market efficiency and competition. By leveling the playing field, regulation supports lower costs, better services, and greater innovation. Lastly, promoting financial inclusion. A fair system should provide access to financial services for all members of society, including disadvantaged or underserved population. So, what is financial regulation? Financial regulation refers to the body of laws, rules, and principles designed to oversee and manage the financial sector. Its core purpose is to ensure integrity, stability, and fairness across financial markets and institutions. It applies to the regulation of financial services, financial products, and financial markets, which aims to protect consumers, maintain market integrity, and reduce systematic risks that could threaten the broader economy. The scope of financial regulation is actually quite broad. It includes rules around raising capital and trading securities, oversight of the operation of financial markets, licensing and conduct obligation for financial intermediaries, disclosure requirements for financial products, and preventing misconduct like insider trading and price manipulation. Overall, it's about keeping the system fair, transparent, and efficient so that both the public and institutions can trust how financial markets operate. So, let's now take a moment to focus on how regulation works in Australia. One of the most devastating events in Australian banking history happened between 1891 and 1893 when 54 out of 64 banks collapsed, many due to reckless real estate speculation. The crash led to emergency legislation in New South Wales to stabilize the system. In 1910, the Commonwealth took over currency issuance, replacing private banknotes, a move strongly opposed by the banks. The Great Depression later renewed focus on regulation. A royal commission in 1935 recommended stronger federal powers, sparking debate that lasted through to World War II. Wartime controls eventually gave the Commonwealth Bank central banking powers and tight oversight lending. These controls were formalized in the Banking Act 1945, which went as far as allowing the federal government to stop banks from serving state and local governments. In 1947, this power was used to block the Melbourne City Council private banking, but the High Court ruled the move unconstitutional. And the third, the government tried to nationalize all private banks under the Banking Act 1947, but this too was struck down by the High Court and later by the Privy Council. These legal battles helped define the limits of federal power and reinforce the role of private banks in Australia's economy. From there, regulation evolved. The Campbell Inquiry in the 1980s led to two major reforms, deregulating the banking sector and floating the Australian dollar. Then, the Wallis Inquiries in 1997 introduced the Twin Peaks model, APRA, which handles prudential regulation, ASIC, which is responsible for market conduct and consumer protection. The Reserve Bank of Australia oversees the monetary policy and systematic stability, while the ACCC ensures competition in financial markets. Later, the Financial Services Reform Act of 2001 created a single licensing regime across financial products. In 2008, the global financial crisis tested this framework, and in 2017, the Hayne Royal Commission revealed systematic misconduct, prompting reforms like the Financial Accountability Regime, which now holds financial executives to higher standards. Today, financial regulation in Australia is delivered through a coordinated network of ASIC, which oversees corporate conduct and consumer protection, APRA, which monitors financial soundness, and RBA, which manages payments and monetary policy. Together, these two institutions work to ensure that Australia's financial systems remain strong, stable, and responsive to change. Australia's regulatory framework is unique, shaped by crisis, inquiry, and reform. To walk us through the more detailed regulatory structure and the key focus areas in Australia's financial system, I will now hand it over to Tan.
Thank you, Isabel, for clearing speaking. Then I'll talk about the Australia financial regulatory approach. Australia is globally recognized for having a stable, adaptable, and comprehensive regulatory framework. This system has helped the country successfully manage major financial crises like global financial crisis in 2008 and the COVID-19 pandemic. By maintaining overall stability and minimizing disruption across the financial system, the foundation of this success is what we know called the Twin Peaks model. which was introduced based on the recommendations of the 1997 Varese Inquiry. This is the one that Isabel just mentioned about it. This model separates regulation into two key peaks. One focused on prudential regulation, and the other one focused on the conduct and consumer protection. This allowing for clearer accountability and better crisis response. Let's talk about the historical context and the Varese Inquiry for a bit. In the early days, Australia banking sector had very minimal regulation. Back then to that years, banks could actually issue their own currency, and that created a lot of financial instability and the systemic risk. Eventually, the 1893 banking crisis forced the government to step in the stronger intervention. Then fast forward to the 1990, concerns about the outdated regulation. This led to the Varese Inquiry in 1996. This inquiry recommended a shift from the old sector-based model to function-based regulatory system. In response, Australia formally adopted what we know that the Twin Peaks model. This model separates financial regulation into two key areas. As I said, one peak focus on prudential regulation and another one focus on market conduct regulation. This helping to manage risks and effectively across the system. Now, let's look at the Twin Peaks model and how it works in Australia. Under this model, Australia created two core financial regulators, each with the clear and separate function. The first one is APRA, which stands for the Australian Prudential Regulation Authority. I will say APRA. It was established under the APRA Act, and its main job is to supervise the solvency and risk management of financial institutions like banks, insurance companies, and the super funds. The second one is the ASIC, or we call it ASIC, the Australian Security and Investment Commission. ASIC is governed by the Corporation Act, and it focuses on consumer protection, financial product disclosure, and maintaining market integrity. These two peaks are supported by the Reserve Bank of Australia, or the RBA. The RBA is responsible for setting money policy and overseeing the stability of entire system. This together, three institutional work to create a strong, stable, and well-regulated financial system for Australia. Okay, now I'll go to the legislative foundation of Australia financial system. Australia framework is built on a strong and well-defined laws that give clear powers to regulators and protect the public interest. The first key law is the Banking Act. This act gives APRA the authority to license and regulate authorized deposit-taking institution, or we call it ADI, which include banks, credit unions, and building the societies. Next, we have the Financial Sector or Shareholding Act. This law places a limit on how many voting shares a single person or group can hold in a regulated financial company. Usually, it's just only about 20%, unless if any shareholder want to hold more than this, they need to be approved by the treasurer. This helps prevent excessive control or influence by any one party over important financial institutions. Finally, we have the payment system, or we call Regulation Act, give the RBA the power to regulate payment system like EFT POS. This ensures that this system remain efficient, fair, and in the public interest. This law together formed the foundation of the financial supervision in Australia, giving structure, balance, and accountability to the entire system. Okay, let's now look at the prudential standard and Basel III implementation in Australia. Australia's regulatory approach is closely aligned with the international standard, especially the Basel framework, which is a global system for regulating capital and liquidity in the banking sector. In practice, EPRA adopts key standards from the Basel Committee on Banking Supervision, especially the Basel III. One of the main rules is Prudential Standard APS 110, which requires ADI to maintain a proper mix of Tier 1 and Tier 2 capital based on their risk-weighted asset. In addition to minimum capital requirements, banks also need to hold the capital buffers like the capital conservation buffer to protect against unexpected losses. What makes EPRA approach unique is how it combines Basel III with its own domestic supervision tools. This includes the PAIRS model, which stands for Probability and Impact Rating System, and the SRI model, which means Supervision Risk and Intensity. This model helps EPRA match its supervision level to the size, complexity, and risk of each institution. Overall, Australia's commitment to this standard reflects a conservative and stable regulatory philosophy. This helps the country avoid major bank failure even during the global financial crisis. Then, have you all remember the COVID-19 pandemic? That time it was very tough time for many people, this including the big companies and financial institutions like banks. When the pandemic hit, Australia acted very quickly and with a lot of flexibility to stabilize the financial system. The Reserve Bank of Australia, or RBA, took very strong action. It cut the cash rate to just only 0.1% and implemented QR, or the quantitative easing, and yield curve control to keep borrowing costs low. The RBA also launched something called the Term Funding Facility, or TFF, which provide over $100 billion in low-cost funding to banks. This helped make sure that banks could continue lending during the crisis. At the same time, EPRA stepped in by offering temporary capital relief. This means that banks could defer customer loan repayments without those loans being automatically treated as impaired. It gave banks the breathing room to support struggling clients without breaching capital or regulatory requirements. Altogether, these actions show that Australia was not only well prepared, but also able to adapt quickly during a period of crisis, helping protect both our financial system and the wider economy. Okay, let's now move on to governance reform, specifically the shift from BEAR to FAR. In 2018, growing public concern about executive accountability in the banking sector led to the introduction of the Banking Executive Accountability Regime, or BEAR. Under BEAR, banks were required to identify key accountable persons and clearly define their responsibility. Also, apply rules like deferred pay to encourage better long-term decision making. However, the regime had one major limitation. It is only apply to banks. To fix this gap, the Financial Accountability Regime, or FAR, was introduced in 2023. FAR expand the scope of governance obligations to include insurers and superfunds as well. It introduced four key obligations. First one is clear accountability. The second one is registration of key executive and defer variable remuneration. The last one is mandatory breach reporting. Unlike BRAE, FAR is jointly administered by both ASIC and EPRA, which reflects a more integrated regulatory approach. Importantly, FAR marks a significant shift toward personal accountability in corporate governance, not just for banks, but across the financial system. This reform also brings Australia in line with global standards, such as the UK Senior Managers and Certification Regime, or we call it SMCR, which focuses on similar principle of individual responsibility and ethical leadership. Okay, to wrap up, let's reflect on how far Australia's financial regulatory system has come. Australia has evolved from a free market, lightly regulated environment to one that now balances international standards with domestic precision. This journey reflects a deep commitment to both market efficiency and systematic stability. So, Australia's financial regulatory framework brings together clarity of function and strong legal foundation, also proven resilient in crisis. The Twin Peaks model is very important here, allowing the focused specialized regulation while still maintaining coordination through mechanisms like Council of Financial Regulators. Australia also alignment with global standards like Basel III, along with strong governance reform such as achieved from BEAR to FAR, further enhance its international credibility. From effective crisis response to forward-looking supervision of risks, Australia has built a system that many would consider global model of adaptive and effective regulation. Okay, now that I have outlined Australian financial regulatory approach, Isabel will take us further by exploring possible improvements through a comparison, looking at how countries like Philippines, Thailand, and China structure their frameworks.
Thank you, Tan, for introducing Australia's financial framework. To begin, I'll focus on the Philippines jurisdiction and its regulatory framework. The Philippines has a well-structured financial regulatory system designed to ensure the stability, integrity, and smooth functioning of its financial sector. Looking at the diagram, at the heart of the systems are three key agencies, each with a specialized role. First, the Bangko Sentral ng Pilipinas, or BSP, which serves as the central bank. It manages monetary policy and supervises banks and non-bank financial institutions to maintain overall financial stability. Next, we see the Securities and Exchange Commission, or SEC, which regulates the securities market. It oversees capital markets, brokers, investors, and publicly listed companies, promoting transparency and investor protection. And then we see the Insurance Commission, or IC, which supervises insurance companies to ensure they operate fairly and remain financially sound, safeguarding policyholders. Lastly, under the BSP, the Anti-Money Laundering Council, or AMLC, monitors and prevents money laundering and terrorism financing by coordinating with financial institutions to detect suspicious activities. In Australia, there are overlapping responsibilities between ASIC, APRA, and other agencies which sometimes create inefficiencies and gaps in enforcement. The Philippines addresses this through the Financial Sector Forum, which was established by the heads of the four key financial regulator, the BSP, SEC, Insurance Commission, and Philippine Deposit Institution Commission. It was formed through a memorandum of agreement, not a legislation, so it doesn't have any legal or enforcement powers. Instead, it serves as a voluntary consultative platform for coordination. Unlike countries like China and Singapore, which use a single unified regulator, the Philippines takes a sector-based approach. This creates challenges, especially when regulatory responsibilities overlap or fall into gray areas. The FSF helps address this by aligning supervisory practices and closing the gaps across the sectors. While the FSF is not a regulatory body, it plays a vital behind-the-scenes role in making the Philippine financial system more coordinated, especially in a complex and evolving financial environment. There is also an ongoing Philippines commitment to financial inclusion through the National Strategy for Financial Inclusion. Programs promoting mobile banking, e-wallets, and microfinance have expanded access to underserved populations, an area where Australia still lags, particularly in remote and indigenous communities. While there might be advancement in Philippine interagency collaboration and inclusive financial policy, there are still ongoing problems on institutional fragmentation, gaps in enforcement, and disparity in access due to continuing systemic barriers. Now, to continue our exploration of financial regulation in the region, Tan and Winter will share some key points about Thailand's regulatory approach.
Okay, thank you, Isabel. I see that the Philippines have a SEC and IC like that in Thailand. So yeah, SEC in Thailand is the SEC or SEC. They handle the capital market and OIC for the insurance as well. So in Thailand, besides of Bank of Thailand, we also have a Security of Exchange Commission and Office of Insurance Commission. The Thai SEC is responsible for regulate the capital market like securities, bonds, and mutual funds. It oversees list companies, markets intermediary, and protect investors, similar like ASIC does in Australia. Then we have OIC as well, which regulate insurance company, both life and general insurance. This is similar with APRA roles in supervising the insurance industry in Australia. So in Thailand overall, BOC is the central of the bank and supervise the commercial bank. Otherwise, SEC Thailand handle the capital and OIC regulate the insurance. But in Australia, those roles are split too. ASIC regulate financial market and protect investor like Thailand SEC, and APRA supervise bank, insurer, and superannuation fund similarly mixed like BOT and OIC. So while the structure is different, the functions are quite parallel. The main difference is that Thailand has separate regulator for banking, securities, and insurance, while Australia combines some these roles under ASIC and APRA. For now, Tan will discuss and analyze how Australia can improve comparison with the Thai law. Then, yeah.
Thank you, Winter. I will introduce a specific law in Thailand for you all. Right now, Australia doesn't have a specific law for cryptocurrency or digital assets yet. Instead, these assets are regulated under the General Securities Law, mainly the Corporations Act. ASIC looks at each case individually to decide whether a token is considered a financial product or not. Even this system looks flexible, but it also creates a lot of legal confusion for businesses and the investors because there is no clear definition or dedicated framework yet. Now, if we compare that to Thailand, it's quite different. Thailand introduced specific law in 2018. It's called the Royal Decree on Digital Asset Businesses. It clearly defines and regulates crypto exchange, broker, and ICO, also the advisory service. All service providers must be licensed by the Securities and Exchange Commission or SEC, and any ICO has to go through an authorized ICO portal. This makes Thailand a strong legal structure and better consumer protection. So overall, Australia approach is more flexible but less creative, while Thailand's system is more structured but also more conservative. To improve, Australia could benefit from adopting clearer definitions and possible introducing dedicated Digital Asset Act, same as in Thailand, to support innovation and ensure market integrity. This is the end of Thailand financial regulatory approach. Then I will hand on to Henry to discuss about China financial regulatory structure.
Okay, thank you everyone for overview the Australian financial regulation system and for your insight for the financial regulation in different jurisdiction. And I'd like to brief introduce the regulator approach in China and how it compare with the Australian module. Since the major reform in 2023, and China has adopted a highly centralized financial regulatory regime. As shown in the diagram, regulatory power is centralized under the leadership of the Financial Stability and Development Committees, which oversee the Central Financial Committee. This political body coordinates all major decisions, reflecting a strong top-down module of financial governance. And there have the three central regulatory institutions operated under this structure. And the first one is called PBOC, the People's Bank of China. And the second is the National Financial Regulatory Administration, and which supervise the banks, insurance, and the trust companies. And the third is the China Security Regulatory Commission. Compared to the Australia Twin Peaks module, where APRO and ASAC divided responsibility based on function, China emphasized the institutional and political control to maintain system stability. Although China has made significant effort to reform its financial regulatory system, some key problems still remain. And one major issue is that the complexity of the complaints. Small banks and regional institutions often struggle to meet the same strict regulatory standard required of large, well-established banks. This created an uneven playing field, potentially limited fair competition in the market. And another challenge is that the rapid growth of fintech and shadow banking. This sector have developed faster than the existing legal framework, leading to regulatory gaps that can put consumer at risk and make supervision more difficult. So there a good example of China regulatory challenge is anti-financial, which is including to the Alibaba, and as we all know, it's called the famous Alipay, one of the country's largest online financial platform. Its rapid expansion explores the key weakness in Chinese regulatory system, particularly in keeping up with fast-moving fintech and shadow banking sectors. In response, authorized imposed the strict structure reform, requiring acts to register as a financial holding company under tight oversight. But this was not an isolated case. It highlights a deeper systemic concern. China's regulatory governance tend to be reactive rather than proactive, often responding after risk materials. This contrasts with the Australian module of the legal independence regulators like ASAC and APRO, who operate under clear statutory mandates. In China, the approach remains more centralized, focusing on macro control, risk prevention, and rapid administrative interaction, but often at the cost of long-term regulatory stability. This style can also result in uneven regulatory burden. Small and regional banks often struggle with high compliance cost, while large tech platforms may initially escape the security until they become too big to ignore. So this developed raise an important question. Even if the financial system are tight, regular, can traditional legal concept like the bank and consumer relationship still function effectively in today's complex digital environment? That's what we explore the next as we move from macro life regulation to the macro life legal foundation of banking. The constructual relationship between banks and consumers and how that relationship is now being reshaped by technology, the third-party platform, and changing explanation. So now in this section, Winter and I will focus on the bank-consumer relationship, not just as legal concept, but also in terms of how it works in practice, which is a concept that lies at the very heart of banking law. So this topic is divided into three parts. The first, I will introduce to the financial legal nature of the bank and consumer relationship and the duty it created. And then Winter will explain the legal rules governing deposits and banking account, including how banks manage different account types and apply their core banking function. And finally, we will jointly explore some of the modern legal challenge that arise from technology change, third-party platform, and evolving customer behavior. Okay, now in the legal natural under the both English and Australian law, the banker and consumer relationship is fundamentally contractual in natural. So it is established when a customer open an account and make a deposit in the bank. At that moment, the bank becomes the debtor and the customer becomes the creditor. So this will has been constantly affirmed in common law. And in the famous case, Johnson and Swiss Bank Corporation, the court held that the banker and consumer relationship is fundamental, one of debtor and creditor. It is not fiduciary biased to cite implied legal duties recognized by courts over time. So now that we've seen how the relationship is formed through a basic contract agreement, let's look more closely at what is relationship initial in legal terms. That's the key legal duties. The core legal duty of the bank include the first is the duty to honor valid payment instruction, provided there are sufficient funds in the account. And the second is the duty of confidentiality. As established in the case Turner and National Preference Bank, the court held that banks owe an implied duty of confidentiality to their customers. This duty is not absolute, but it's subject to four narrow expectations: the legal consumption, the public duty, the bank's own interest, and the customer consent. So additional expectation duty to exercise reasonable care and skill when executing customer instruction, particularly when handing checks, a transfer, or online transaction. In addition, banks are generally accepted to provide reasonable notice before closing account, avoid arbitrary or capricious conduct in their dealing with the customers. This legal principle from the foundation of trust in traditional banking. However, things become more complicated when we introduce the modern technology and digital banking platform. So we were in the next challenge from the modern technology and the platform. So in today's financial ecosystem, the traditional two-party model, the one is a bank and another one is customer, is being disrupted by new form of several delivery. The customer now interact with banks through application, wallets, embedded fintech platform, and third-party provided. These innovations bring great convenience, but also create legal uncertainty. For instance, in Australia, several services like the PayID and the new payments platform, the Google Pay and PayPal, and enable real-time transfer, but they raise some new concerns for what happened when a customer is tracked into the authorizing a fraudulent payments. And another is what if the transaction is initiative via a third-party application? Is a bank still liable, or does the risk shift as well? These problems are even more present in China. Platforms like the Alipay, WeChat Pay, and some international bank, WeBank, offer a full financial service, often without the customer ever interacting with the licensed commercial bank. So according to my banking experience, I have seen some early clients guided to open digital only account via mobile phone application without fully understand the implications leading to the dispute over access rights. So maybe they will get the fraud or scam and frozen balance. These questions become, can we still apply traditional legal duty, such as care, honor, and confidentiality, when the customer is interacting with the software rather than a human banker? Of course, legal responsibility doesn't fall on the bank alone. Let's now turn to the customer side of the relationship. So they have the responsibility of the customer. They also have some legal duty, including providing account and trustful information when opening account, and keeping access credentially, such as keep the PIN and the password, especially when ensure that safe and secure. And the cooperating with the bank in the event of suspicious activities or fraud. So in Australia, contributory negligence of or branch of the account terms by the customer may reduce the bank liability in fraud or loss cases, but the line is becoming increasingly blurred. So with biometric logging, AI-powered approve and third-party integration, it's often difficult to determine whether a customer truly consent a transaction or whether they even understood what they were authorizing. Actually, do you guys remember the case we discussed in our legal memo exam? The one involving that Japanese cop who went to the bank and applied for a mortgage because of the language barrier, and with the bank relying on the AI-based system to explain terms. So they ended up signing documents, but they didn't fully understand it. So these questions rise as some important legal issue. If the system say consent was given, but the customer didn't comprehensive understand the terms, should that the consent still be valid? And more important, who bear to the legal risk? So in a nutshell, this mutual obligation between banks and customer forms the legal backbone of modern banking. But how are these duties actually implemented in practice? In other words, how do legal responsibility translate into the daily operations, such as deposits, withdrawal, and account access rules? To help us understand how the principle apply to be real working of the banking account, I will now hand over to Winter. She will walk us through the next part.
Okay, thank you, Henry. As Henry already explained us about the foundation of the banker and the customer relationship, we now understand that a deposit transaction creates a debtor and creditor relationship between the bank and customer. Building on that, I will now go into more detail about the legal status of the deposit and the legal rules relate to bank accounts. These are key to understanding how this relationship works in practice under the Australian banking law. Okay. Number one, I will explain about the legal status of the deposits. Let's begin with the fundamental principle. When a customer makes the deposit money into the bank, that money ceases to be the customer's, it becomes the bank's property. The bank has the right to use the fund it sees fit, and in return, it has a contractual obligation to repay an equivalent amount to the consumer upon demand or under the agreement term. This is a debtor and creditor relationship, not the fiduciary one. This was clearly established on the Foley and Hill case. The legal status also depends on the type of account as well. The current account, repayable on demand, but the saving account or term deposit account usually require prior notice with withdrawal and often impose penalty for early withdrawal. In all of this, a customer is considered to unsecured creditor of the bank. Second, major type of accounts. It has three major accounts. First, current accounts used for everyday transaction and often connect with EFT system that we tap online every day. Most transactions are conducted through current account. An important feature is they're used for the third-party payment like Google Pay. While this was traditional done by check, payments are now primarily electronic, including ATM withdrawal, EFT or debit card payment, maybe with or without the PIN, internet transaction direct to the third-party account, recurring payment via direct debit and credit system. The current account may or may not bear the interest. If they do, it's very low. They are rarely used to credit facilities for the customer or overdraft. If used this way, the bank becomes the creditor and the customer will become the debtor. For the saving account, it have a traditional saving account and term deposit. Traditional saving account differ from the current account as they earn the interest and could not be drawn on the check. Now, most allow electronic third-party payment. Withdrawal often require notice or are subject to the limits. These accounts are more likely to be governed by a writing contract, outlining deposit and withdrawal condition, interest rate, and other terms. Their primary purpose is investment and helping banks manage long-term funding, as opposed to current account which provide immediate liquidity. Despite functional difference, both saving and current account legally operate as loans to the bank. For the term deposits, require funds to be left untouched for the specified period, often without third-party payment facilities. Some may have fixed term and early withdrawal typically incur penalty or require prior notice. Third, I will talk about the appropriation of funds. I believe that everyone has more than one account, maybe one for the daily use and one for the saving goal, right? So appropriation refers to the application to fund to the particular account or transaction. Let's see in the daily and Lloyd case, the court confirmed that the customer may direct how funds are to be applied, and if not, the bank may do so. The important thing is the customer choose which account or what money is used for a particular purpose. If the banker accepts this, the bank must comply or respect that purpose. The customer should clearly notify to the bank of their intention. If the customer does not appropriate the payment by themselves, the bank may right to do so, especially where the bank used the fund to pay down an overdraft. Appropriation also describes the situation where the particular entry in an account is set against a transaction on the other side of the same account. This may be necessary decide which several competing claims have priority when the account is insufficient to satisfy all. It have a Clayton rules from the Divan and Nebel Clayton case. The court held that the first in, first out rule is actually just a presumption, not a strict rule. If the customer or bank clearly show the different intention, that will override it. Also, the rule does not apply the overdraw account or to same-day transaction where there's no clear order. Okay, next I will talk about the combining account. The bank may combine account if one is a credit and other one is the credit. This was except in the Garnet and V and MK1 case. This case established that the bank has the right to combine a customer account without prior notice. The right to combine is useful when one account is overdrawn and another is in credit. This helps the bank to recover easily. However, this right is not absolute because it's no obligation on an institute to treat separate account as one. And if the customer wish to prevent the combination, they must clearly communicate this intention to the bank. Account of sufficiently different nature, such as current and loan account, cannot be combined. And the trust account not include from the combination if the bank are aware they are trust account. And under the banking code of practice also, they outline that the bank must notify customer before combining account and prohibit the combination in case of the financial hardship, particularly when the facility is regulated under the National Credit Code and the Bankruptcy Act as well, the Section 86, establishes the limit of the right to bankruptcy scenario. Okay, then I will talk about the overdraft account. An overdraft account will occur when the current account goes into negative. This is common from a short-term business credit. The bank may take security interest from the customer. Informal overdraft might be not arranged beforehand, which may cause the problem with the lower income customer who may incur fee unknowingly. Under the banking code of practice, informal overdraft on basic account are not permitted without the customer prior agreement. A bank can charge interest, either simple and compound interest based on the user and commercial custom, but they cannot be the charge penalty. It have a 3 case outline the penalty fee that unavoidable. First is Bell's Pacific View case. The court held that a default rate that is out of all proportion to the June pre-estimate of loss is considered unenforceable. For the Ring Low case, the court held that a penalty must be extravagant and unconscionable in amount, where this proportionality is not enough. For the partial case, the High Court held that the fee must be so large that it is unconscionable in comparison with the maximum damage that could flow from the breach. The test is whether the clause punish rather than compensate. 6. The joint account. The joint account is open in the name of 2 or more people. This account raises several issues like whose signature is required to open and operate account. Debt are owned jointly and severally, so check should generally require all signature unless agreed otherwise, or what happened upon the death of one account holder. The general rule to cover this is a presumption of survivorship. The surviving account holding is entitled to the balance. However, this presumption can be rebutted if this clear evidence of the different intention, especially where only one person contribute the fund. Let's see the first case, Russell case. An aunt and nephew hold a joint account fund only by the aunt. The evidence clearly show that the aunt have an intent to the fund to go to her nephew upon the death. So the court upheld that this is an intention. In contrast, the Brophy case, a wife fund a joint account used by both spouses. There was no intention to give the fund to her husband. so he held term in trust for her. Another key issue is when the bank honor the check missing require the signature. Let's see the Arden case. If the bank agree to honor joint drawing, it must not process check signed by just one party unless expressly allowed. So next, I will talk about the financial claim scheme. What is this? This is a depositor protection mechanism under the Division 2AA of the Part 2 of the Banking Act. It guarantees the depositor fund up to $250,000 per person per ADI. If the institute become insolvent, the minister may declare protect account if APRA wind up an ADI. Most common deposit type are protect, but foreign current are not. So then I will talk about the statement with the 4 parts. First, the legal effect. There are no duty of the customer to read the statement or report forgery. Any term impose such a duty must be explicitly drawn to the customer's attention. Is let's see like in the NAP and DOI case. For the verification clause, stating the unchallenged statement are deemed correct, are not void, but must be clearly incorporated. Let's see in the Thai Hing Cotton Mill Company and Louis Chong Hing Bank case. And in the C, evidence against the bank is focused in the 3 cases. First, Lloyd Bank and Brook case. The court held that if the customer rely on the incorrect statement in the good faith and overspend, the court may be exculpated from recover. But in the British and North European Bank and Southstein case, if no reliance, the bank may correct the error. As well as the United Overseas Bank and Jivani case, the banks can recover money credit and in error if it's clear and honest mistake. For the last one, electronic statements are treated by the same law, but bank can often track whether a customer has accessed a statement or not. And then I will talk about the freezing account. In some cases, the bank should refuse withdrawal from the account. In order, the banker may also refuse further deposit. There is no implied term requiring prior notice before freezing an account. This is because requiring such a notice would contradict the aim of protecting the bank and the customer. It has a 3 circumstances like where the account are frozen. First, mental capacity. It can see in the Gibbon and Wright case, where is the court held that each party must be sufficient soundness of mind to understand the general nature of what they are doing. For the days, the customer did terminate the authority to honor check and bankruptcy circumstance under the Bankruptcy Act aim to treat the creditor equally and provide relief to insolvent debtor. When bankruptcy is declared, assets will transfer the trustee. Lastly, I will talk about the garnishee order. What is this? This is knowing as a third-party debt order. It clearly show the meaning in the Part 72 of the Civil Procedure Rule in UK. It is a legal mechanism allowing a judgment creditor to claim money directly from the third party who own money to or hold money on behalf of the judgment debtor. The court may order that the third party, such as the bank, pay the creditor instead the debtor. In practice, the court will issue the order city with temporality prevent the third party, like the bank, from paying fund to the debtor. The money is then said to be the attached. If the order becomes absolute, the third party must pay the money to the judgment creditor. However, only money already in the account at the time of the order initiate can be attached. Joint account cannot be garnished unless all account holders are judgment debtors. So it have a case study. It's like a Societe RM shipping company and C international case. The House of Lords held that English court cannot enforce garnish order against a foreign bank branch. This decision limit that international reach of the garnish order. So to wrap up, a legal status of the deposit and account under Australian law reveal a complex but structured system that protect both bank and customer. By understanding the nature of each account type and duty imposed on the banker, we can better understand how legal principles support modern financial system. So for now, I will talk about the challenge in the modern context. After COVID-19 pandemic, the way people spend and pay has changed fast. One payment method that's rarely taken off is buy now, pay later or BNPL. Why BNPL means you can got what you want now but pay later. In legal terms, a banker-customer relationship is quite specific. If you deposit money with the bank, the law treats you like the creditor and the bank will be the debtor. That relationship comes with the obligation like confidentiality, process payment on instruction, and even the duty to intervene the case upfront knowing quincy care duty, as Henry already explained. But BNPL provider, some often is not a bank. They don't take the deposit. They're not authorized under the Bank Act. And so that whole set of common law duty that apply to bank doesn't apply to them. Instead, what you have is a credit provider offering you the short-term loan, often interest-free, and collecting it in installments. So this is the legal problem. For years, BNPL operate outside Australian core credit law because it doesn't charge the interest. Most providers weren't governed by the law called National Consumer Credit Protection Act. That means no responsible lending duty, no credit check, and no law obligation to ensure affordability. Even more importantly, there was no secure duty as well. Since it was no deposit relationship and no instruction-based account, and no guarantee access to dispute resolution mechanism like AFCA. But it is start to change now because last year, December 2024, Parliament passed the Financial Sector Reform like Buy Now, Pay Later Act. The Act received royal assent on 10 December 2024 and give provider until 10 June 2025 to comply. From that date, provider will be required to meet modified responsible lending obligation. That means they need to check whether a person can afford repayable or not without substantial hardship, taught under the simpler, more flexible model than traditional credit contact. This is a big step and a sign that the law finally recognize BNPL for what it is, the credit, not just a payment convenience. BNPL represents a shift of both technology and consumer behavior, especially after COVID, but a legal definition having cost out. The traditional idea is a customer or bank doesn't fit neatly into this new model. And for the long term, BNPL providers set outside the protection and obligation we apply to bank and licensed credit provider. For now, with legislative reform finally in motion, Australia is take steps to close the gap and bring new financial model like BNPL into the legal fold with protection that met their risks. So now, Henry will talk about another challenge in the modern context.
Okay, thank you very much, Winter. And now I'd like to talk about the further by focusing on another set of legal challenge, those brought by modern payment system. Like I just mentioned that the Pay ID, the BPay, the new payment platform, and the digital wallet. This technology have transformed how customers interact with bank, payments now happen instantly, often without human interaction and across a growing number of digital platforms. Well, this convenience is great for users. It's introduced a new legal uncertainty that challenges the traditional assumption about the banker-customer relationship. So let me highlight some three major concerns. And the first, the issue of the loss of control. In real-time system like the NPP, once a consumer authorized a transfer, even mistakenly by under fraud, the money is usually gone with a second. That raises some difficulty questions. Can the bank reserve the payments, or does it still own a duty of care, or has the customer by pricing confirm take full legal responsibility? So this also has a big question we need to think. And the second, the problems of consent and identity. With digital wallet and embedded application, customers often don't realize who they are actually dealing with. Is it a bank or is it a third-party provider? And when something goes wrong, like an unauthorized transaction or scam, it becomes unclear who is legally responsible. We were seeing this in case involve PID fraud, where customers were tracked into transferring funds to the wrong person. Legally, the bank may argue that it followed the customer's instruction correctly, but from the customer perspective, they were clearly misled and the money is gone. The third is a platform problem. When a payment is initially through a fintech application or digital wallet like the Apple Pay, Alipay, and WeChat Pay, etc., we need to ask, is the bank still bounded by the traditional duties, such as confidentiality care or accuracy, or are these duties deleted when third-party platforms are involved? In China, where I worked at the Bank of China, I've personally seen this issue arise. Some customers, especially the early rural clients, often don't understand that by using a digital wallet, they might be stepped outside the protection of formal banking regulation. And one problem happened when they were caught between the platform and the bank with no clearly legal resource. So in summary, modern payment systems offer speed and convenience, but they also crowd some the legal safeguarded that underpin in the traditional bank and customer relationship. So that lead to the bigger question: what can regulator and the lawmakers do to respond? To help us explore some possible solution, I will now hand over to Isabel and Tan, who will share their view and how legal system might address this modern challenge.
Thank you, Henry. I will talk about another legal problem that is facing the banks now, which are third-party risk. As banks continue to outsource more functions and services, there is an increasing third-party risk for banks. This includes a variety of threats such as operational, cybersecurity, compliance, and legal risk. When bank relies on external providers for these key services, they also expose themselves to this risk indirectly, making it essential that the risk management framework extend to include third-party oversight. Bank must then implement comprehensive due diligence processes before entering into partnerships, regularly audit and monitor these third-party providers, and include clear and contractual protections such as data security obligations and liability clauses. I will now hand it over to Tan, who will talk about another legal problem that we face today.
Thank you, everyone. As you all mentioned before, that today's technology is very advanced and convenient, like the using of mobile banking. But on the other hand, in my opinion, there are some drawbacks about this modern banking system. As scams through mobile and banking networks increase, so regulators and lawmakers may need to impose stricter duties on banks to appropriately detect and prevent fraudulent activity. And banks should find a way to return money back and share fraud database and real-time alerts. This can help mitigate these leaks. Yep, this is my opinion.
Okay, thank you, Isabel and Tan, your understand and the suggestion. And now I need to conclude our presentation. So let me briefly reflect on what we've covered today. So as we topic in the topic one, we examined how financial regulation operates in Australia and compared its a different system in Philippines, Thailand, and China. And in topic two, we moved from the system to individuals, exploring how the law defines the bank and customers' relationships and how that the legal framework is being challenged by the digital technology and evolving customer behavior. And there I need to conclude some key insights. One of this is robust regulation is necessary, but not sufficient. Financial system must also ensure personal legal protection for consumers, especially in an age where banking often happens through screen and more applications, not over counters. So what should we need to attention from our discussion? Several challenges stand out. There is a rise of fintech and third-party platform and shadow banking, the rapid evolution and some payment system, and the need of the clear allocation of responsibility when things go wrong. So this legal gray areas call for reform to strengthen customer protection and update assumptions. So about the final thoughts, as we can look ahead, we ask, how can financial law remain both technology robust and personal meaningful? That is a challenge for modern banking law and also its opportunity. So thank you, everyone. Thank you for our presentation.
Thank you.
Thank
Thank
you.
Thank you.